Sacci's Trade Activity Index for July dipped further into negative territory, falling 19% to 38 index points. Neren Rau, CEO of Sacci, now joins us in studio to unpack that report. Neren, thanks so much for joining us. You're pretty much becoming a regular on the show, with the months rolling by faster than we can grasp and bringing to the fore new data points. And today, as I mentioned, we've had the Trade Activity Index coming to the fore, dipping further into negative territory. We've gotten used to the volatility in this index this year, but that's a huge margin of decline that's actually come to the fore here.
Absolutely. I wish I was a regular that came with more positive tidings, and it's becoming more difficult to find the silver lining in our data in recent weeks and months. The Trade Activity Index has reached a record low. The last time we saw the level of 38 was in March 2009. The only time we dipped to a level below 38 was in April 2009, where we saw a level of 32. And when one looks at an index which has no meaning in itself as a number, one has to use its historic performance as a benchmark for what we're experiencing right now. And the March to April period of 2009 was particularly bad in terms of overall economic performance, and what we're seeing now is similar levels of activity as compared to that time, even though we should theoretically be in better periods of economic activity than we were in March and April 2000.
While that may be the case in point in theory, let's take a look at practically what's coming to bear here, because if we're drilling down into the components, I mean, the sales volumes index declined to 39 after dipping to 50 in June, and then we've had new orders also moving in tandem.
That's right. Those are clearly indications that the expectation for the coming months is not a very positive one. And the only upside that one can look at in terms of these numbers is that they're showing us that inflation is contained. However, there is a sensitivity to cost pressures potentially impacting this index in the coming months. So it's not to say that inflation is contained and will be. There is still a vulnerability in the index. But the outlook in terms of greater activity within the trade environment, and consequently greater activity within the broader economy, because we read this index as an indicator of broader economic activity, is fairly bleak right now. We expect that it will remain at low levels for the rest of the year, hopefully slightly improved from the current levels, but we don't expect a dramatic improvement into higher levels of positive territory in 2011. We unfortunately have to move that outlook to 2012.
Of course, further cementing the fact that inflationary pressures could come to bear and that we remain vulnerable to those cost push pressures moving forward is the fact that we had selling prices being maintained if you're comparing the July figure to June, but input prices rising 6%, and that further cementing what you're saying here.
That's correct. That was the basis for us determining that although there's a containment now, there's a vulnerability in the future. In addition to that, one also has to look at the current cash position of firms. And even though many enterprises, especially small and medium enterprises, are in a very difficult circumstance as far as cash flow goes, even those enterprises who are in a better position, corporates in particular, which are in some cases even cash flush, they're being very cautious about investing those funds to generate greater levels of economic activity. And one can only ascribe that type of cautious behavior, whether it's stimulated from a lack of cash flow or whether it's stimulated from a caution, even though that cash flow does exist, is because the economic outlook is very poor. The risks that they foresee on the horizon, both from an economic perspective as well as from a policy perspective or a confusing policy environment, causes them to be reticent in terms of becoming more involved in the economic environment.
We've seen the effects of that filter through quite clearly to the employment space specifically. I mean, we've seen businesses possibly using this as an avenue to save on costs, and where we've seen pressure on margins and declining cash flow statuses, so to speak. Run us through that, because it's the strike season, one would assume, that would have a sobering effect on that employment picture as well.
Yeah. Going into the strike season, the employment components of these indices were performing poorly already. And now that we find ourselves in the midst of the strike season, or now that the data is applying its mind to the initial months of the strike season, we find that both on the current as well as the expected employment components, we found a negative downturn. And when both of those components turn negative simultaneously, one can only read that as the impact of strike season having a direct impact on businesses not being optimistic about employment, not just currently but into the future.
Yeah.
So the impact of strike season is very clear in this index. If only one of those indices had turned more negative than it was and the other remained balanced or positive, then one could say that business is looking beyond the strike season to better times. But clearly business is saying that strike season is not just impacting on your employment prospects now, it's impacting on the way in which we consider our relationship with labor even in the coming months of 2011.
And Neren, overall, when you come back a month later, I mean, what are we expected to see on this index? Further deterioration?
Hopefully not. We're looking at levels now on the Trade Activity Index that we should not be testing in an economy in recovery, even if it's an extended or protracted recovery. We should not be testing the levels of 38. We should not be testing levels below 40. And at the very least, in terms of the expectations index, we shouldn't be this close to 50 because the expectations index does suffer from a positive bias.
Yeah.
So while you're in recovery, it should be well clear of 50 at the very least. And we're hoping that this is a bottoming out of the index, that there's a turning point that we're seeing right now, and that in the coming months we will recover firstly to 40 and then towards the end of the year attain levels of 50 plus again, starting the new year with an optimistic 50 plus or even 60 plus in terms of trade activity, and of course supported by higher levels in terms of trade expectations.